So our trading principle is very much to do with auctioned or extreme points, okay, highs and lows in the market. Now, what's very ineffective with looking at traditional charting tools like candlesticks is that they don't tell you a great deal about how a high and low is formed. And that's where, if anyone asks me what's one of the key underlying reasons why I use a footprint tool, it's to actually look at how a high and low is formed. It's to really almost drill in and see what were the buyers and sellers doing at that point, which has now become the high and low of a day. So that's what we're going to talk about in this principle. It's about understanding and interpreting how a high and low is made, and what that means in terms of future implications. I think that's the real key behind why every single day I observe how a high and low is made. Okay, so the first thing to understand is whether a high low is made through auctioning or whether it's made through exhaustion effectively. Now, I'm going to just briefly illustrate these for you and show you the difference. Right? An auction low is simply where a market comes in to an extreme point. We're going to call this support, and once we get to that price point, whatever it might be, let's use the oil and let's call it 69.00. So once we get to that price point, what we see not just sellers taking profit, but we also see buyers entering the market and actually supporting the market. So they buy the market back up. Okay, so that's what we call an auction process, where the market comes to, what the bigger time frame players might deem as a discount. They step in and buy the market back up. So you have a combination of new buyers entering the market as well as sellers taking profits. And that's why we get that, what some would call a V-shaped reversal, or an auctioning process, where we do see, a switch over from selling to buying. Okay, so that's what we call an auction extreme. Now, an exhausted extreme is where we do have that same selling, but this time, however, what we get is we just see the market effectively sit at the lower end. Okay, and this sitting at the lower end is effectively created through, again, we do see some buying, but we get a result of effectively no real aggression from the buyers. It might just be a little bit of spreading, it might just be a bit of position squaring, a little bit of profit taking from sellers, but in essence there's no real interest to buy that market up at that point. And that's the real key difference between an auctioned low and an exhausted low. Now obviously it's the same for both an exhaustion high and an auctioned high. Now to see and understand this, what I'm going to do is I am going to bring up some examples for you so I can show you what it looks like. But ultimately what you want to determine between this auction and exhaustion is what's a good low and what's a bad low. Now there's a tendency, as a rule of thumb, exhaustion highs and lows we would tend to call bad lows. Okay, they do tend to get taken out and continuation through those areas, whereas good lows do tend to act as sort of extreme points in the market for some time. Now the reason we want to identify them into two categories is that it allows us then to begin to impose certain probabilities on things. Okay, for instance, let's say we've seen a market sell off quite aggressively for a number of sessions, and all of a sudden we get a very nice auctioned low. Okay, the probability of that being a good low in the market for a couple of days, weeks, and maybe even months is a lot higher than if we had an exhausted low. Now that's the real key takeaway for the difference between auction lows and exhaustion lows. Now the second is obviously what are the future implications. In other words, what does it mean for the market going forward? Now, if I told you there's an exhaustion low that formed in a market, the day after, we maybe had an inside day, you would say to me, well, the future implications are that we're likely to test that low and continue in that direction in the days ahead. And that's the real key. That's why we need to identify these two different types of extreme points. Okay, so what we're going to do is we're going to actually pull in now into the oil, and I'm going to take you through the process of identifying the highs and lows. And I'm going to use yesterday, obviously the 16th of July as the example. I'm going to start off with the high of the day, and we're going to go through it. I'm going to show you what it looks like, and then ultimately you can decide for yourself. Okay, so here we have the high of the day. It's 70.75, and what we can see, market comes into this point, we can see a nice pickup in the volume. Obviously these are all 5-minute bar rotations. If you don't know the footprint tool, again, that's what the course is there for. It's there to teach you all the intricacies of the tool. But in essence, we can see the market gets up to that high, and straight away, not only do we kind of rush up into that high, but very quickly prices get smacked back down almost 15 ticks off of that 70.75. So we could see a little bit of a pickup in volume, but ultimately the market very quickly quickly navigated and auctioned its way back away from the high. So we can really see that, as quickly as those buyers got into that 70-75 is as quickly as those sellers took it back out. There was no real overlap. That's the one thing we talk about. We want to see the degree of overlap at higher prices, and we can see that there was no real volume traded from all the way from sort of 70, 66s all the way up to 70, 75s. There was no interest in those top 10 ticks to trade. Okay, the market did settle and a bit of volume traded at 70, 64s. But again, once that buying activity was finished, we then saw those sellers step it up and the market began to pivot lower. Okay, so we can see a very, very nicely auctioned high there, a good high. That's what we call a very well auctioned high. Now, if we go to the low of the day, let's have a look what the low of the day looked like. So again, if we come towards last night, okay, this is the low of the day then. Now look at the difference between this. All right, so we could see obviously the high of the day yesterday, we had no real volume traded, no real absorption, and the market navigated away. In this instance, note the difference. Okay, market comes down, quite a lot of absorption, nice dark colors, high volume. Okay, and again, look at the next rotation. We almost traded a good 700 lots in the lowest three prices of the day. Okay, the market tried to bounce, but we kept seeing trade being facilitated in this lower bound. So in the lowest 10 ticks of the day, if you were to go accumulate all the volume traded, we almost did 15,000 contracts in that lower 10 ticks of the day, versus if you go compare it to the high, it was roughly around 2,500 contracts. So that's the real key. You can really see that there was a disinterest to be buying higher prices aggressively, with quite a lot of interest to obviously be selling in this lower region. And this is what we call an exhaustion low. It's almost like, it's not that the sellers stepped out of the way, but the sellers almost, they'd done the business, and the buyers were not really inclined to be buying the market and supporting the market. Ultimately now we've got a poorly auctioned low in the market, and that's the real key takeaway from the oil. The implications of that is today is a day two trend. What that does mean is there's a high significance this low is going to get tested. Currently now it's around about 9:30 in the morning, and we can obviously see that oil is trading around $68 a barrel. So there's a good 40-50 tick opportunity to look for shorts in the oil today, to target not necessarily a trend breakout, but to target a retest of this low and maybe a small extension. Okay, so that's how we identify good lows and bad lows, utilizing the footprint tool.